Good afternoon, ladies and gentlemen. A very warm welcome to you all on this very special episode of Market Today. Let me just say it's an investigative episode. With me is Sakshi, and we go through this 105-page document that Sebi has released, nailing Jane Street's run on the derivative market in India, also the world's largest, and helping Sebi is Mayank Bansal, president of a UAE-based hedge fund, who's worked on this case in an individual capacity and blown the lid of Jane Street's malicious impact on our derivatives market. Namaste to you, Mayank ji, and a very warm welcome. Please allow me to introduce Mayank in a manner which will make you understand as to why he's the right person to have nailed Jane Street. And since 2010, Mayank has been working in the world of options and futures at Nomura, and for the last 12-13 years he's worked extensively at Edelweiss. In fact, Mayank is one of the largest F&O traders in the Indian market and just the right man who could understand the very vicious strategy that Jane Street deployed to earn, Sakshi, the number is 43,289 crore rupees as wrongful gains on derivatives market. So this, Mayank ji, is something that you've done as a brilliant job in keeping the integrity of the Indian market very safe. Could you please explain to us in very simple manner as to how Jane Street was running this malicious and malintentioned show, making a fool out of retail investors and in turn making thousands and thousands of crore rupees, Sakshi, all of them tax free?
Yes.
Mayank ji, over to you.
Thank you, Shailendra ji, and hello, Sakshi ji. Thank you for the warm introduction, Shailendra ji. So, this has actually been going on since July 2023, and it's been going on. It's only very recently that Sebi has picked up the investigation. What Jane Street, or the manipulating entity, what it effectively was doing is that it was taking outsized positions in the derivatives market, and then on expiry days, only on expiry days, it would take outsized positions on the derivatives market, and then it would move the underlying to suit the profitability of those derivatives positions. So that is what, in very simple terms, Jane Street was doing. You would appreciate that, before December 2024, there were expiries on every day. So Midcap Select had its options expiry on Monday. Fin Nifty had its options expiry on Tuesday. Bank Nifty had its options expiry on Wednesday. Thursday was Nifty. Friday was Sensex. So this was the order of expiries. So every day there was an expiry. And of the underlying, which was, of whose expiry it was, that underlying has been thoroughly manipulated over the last 2 years. The constructs of manipulation also I can get into. It's slightly technical, but I can get into those.
Okay. What we'll do, ladies and gentlemen, and Mayank ji, for the benefit of our viewers, we've made a graph of the Bank Nifty on a particular day when Jane Street has allegedly manipulated it immensely. I'll request the PCR to kindly fire that graph. It shows the Bank Nifty candle on January 17th, 2024, a Wednesday. And on this day, Sakshi, the Bank Nifty fell 2,065 points or 4.28%. The candle a little later, a bigger candle after that is on 23rd of January, Tuesday, on which the Bank Nifty slipped another 1,287 points. And it is on this day that Sebi's investigation has shown that Jane Street made a profit of 750 crore rupees in this single expiry.
Yeah.
Mayank ji, could you please explain to our viewers the modus operandi that this quant trader followed?
Yeah, so as far as the interim order goes, okay, in this case, what has happened is that Bank Nifty opened at a certain price. It opened lower. HDFC results were there the prior day. So it opened lower and then it shot up. It shot up very steeply. At this point, once it shot up, this shooting up of Bank Nifty was due to the buying of securities by Jane Street in the cash segment. That, that buying in the cash segment led to Bank Nifty shooting up. Once it had shot up, at this point, the manipulating entity has cash holdings, right? At this point, once it has shot up, it established via options extremely heavy short positions. So it went long puts and short calls, which basically is both of them make money in case the markets fall.
Yes.
So they went long put, short call, and in heavy quantities, extremely heavy quantities. Do note here that at this point, they're still holding the cash. Their intention all throughout was to dump the cash aggressively at the end so that all those very heavy options positions that they've established when they bought into the stocks could expire heavily in the money. In the money meaning extremely profitably. So that was the modus operandi. In this process, they will lose something in cash. Okay, so there have been losses in the cash segment because they're buying aggressively and selling aggressively. But that is more than multiple times offset by the profits in the option segment. So at the high, when they took it, to the highest point, they established a lot of options positions which were to profit from a downfall in Bank Nifty. Having established those, they sold aggressively the cash holdings that they had to expire the heavy options positions, far bigger positions than the cash holdings that they had, extremely profitably. It's called expiring in the money. So they expired them in the money. This is the modus operandi.
Mayank,
Yeah.
I also wanted to get some clarity out there for the viewers. Right at the beginning, Shell mentioned to all of you that in the interim order that's been signed by Sebi, the total amount of earnings that Jane Street made was to the tune of about 44,000 odd crore rupees. Now, as Mayank points out, that there were some deliberate losses also that the company incurred to the tune of 7,000 odd crore rupees, and minus that then you come to the overall profits of 36,000 odd crore rupees as well. So these losses were incurred deliberately, Mayank. How would you explain that?
Yes. So these losses would typically be in the cash or future segment because those were the instruments used to move the market. To move the market or there are actually two forms of manipulation. One is a violent manipulation, which is where this expiry, which Sebi has covered, falls into. There's a quiet manipulation also. As far as violent manipulation is concerned, you will typically see, losses in the cash and futures market, which have been used as instruments to move the market. So
Right.
there you typically see losses and a multi-fold gain, multiple times the losses that have been incurred there, you will see in the option segment.
Okay.
Right.
Mayank, one question that I have is, I want, and most of the viewers would want to know, how is the Sebi calling this strategy of Jane Street as manipulative, and how has it come to a conclusion that these 4,800 odd crore rupees is unlawful gain, is illegal gain? You have explained to us the modus operandi. You have talked about the contrasting positions that Jane Street took in a large quantity, but how will Sebi be able to prove that this was manipulative strategy, this was intentional and not just and an illegal action? Because right now holding two contrasting positions in the markets is not seen as illegal. There is no law that calls it illegal. So how are we coming to that conclusion?
The conclusion is fairly obvious because the size of contrasting positions is extremely off and one position is being held solely to benefit the other at expiry day.
Okay.
You would appreciate, Shailesh ji and Sakshi ji, both of you, that options expiries are cash settled. So
Yes.
on the expiry day, they simply settle on the cash. You don't have to sell it again, which would create market impact and make it tough for you to square off large positions. They simply expire at the cash settlement level. So, establishing large positions, outsized positions they are very large positions, outsized positions in the derivatives market. And then, moving cash with the sole intention of expiring all those positions in extreme profit, with the sole intention of that, is telltale textbook manipulation. So that is what Jane Street has done. It is manipulation under, if you see SEC also, it is market manipulation is taken very seriously in SEC. and there also it is manipulation. DOJ has pursued criminal action against several top traders precisely for these kind of cases. In fact, even locally home, within India, Ketan Parekh has been jailed precisely for market manipulation.
Okay.
If you see, there is a regulation called Prevention of Fraudulent and Unfair Trade Practices, FUTPA, PFUTP, FUTPA it's called, Prevention of Fraudulent and Unfair Trade Practices, which is implemented by Sebi like a law. In the past, there have been several precedents, specifically to your question, there have been several precedents wherein Sebi has banned entities and fined them precisely for this kind of market manipulation. So it's not that, this is something the scale is unprecedented. I would also like to explain to the viewers here the extent of magnitude. Jane Street in 2024 made 25,000 crores from Indian options trading. Just let that sink in. 25,000 crores. It is the summation of the scams of, Vijay Mallya plus Nirav Modi plus Ketan Parekh. And I'm talking about a 1 year number. This is happening on a recurring basis. Just
And one more important part. Yeah, please continue.
I'm done.
Okay. So, to Sakshi's question, the interim order very clearly mentions that the PFUTP, which is the Unfair Trade
Yeah.
Practices Act, the regulations are 3A, B, C, D, E,
Yeah.
4,
4A,
1
yeah.
and 4, 2, A and E. So,
Yeah.
they have analyzed every single trade, and if I may add, ladies and gentlemen, these are 21 days, 21 expiries that Sebi has so far been able to analyze. Out of those 21, in 18, a lot of money has been made, and very clearly Sebi says that in the remaining 3, what Jane Street did was that it very aggressively towards the end of the day tried to manage the index in a manner that its positions would close into profit. So there is actually a lot of tables that Sebi has given where bunch of orders, Sakshi, were filed between 327 and 329 on all Nifty constituents and all Bank Nifty constituents. And Jane Street's trades as a percentage of total trades have also been shown, which are substantial percentages in double teens. So that goes on to show that Jane Street was trying to close the index in a manner which is favorable to its options positions. Mayankji, you will be better able to explain to our viewers how this works and how does this impact the option closing price.
Okay, so I will explain now. So there are two kinds of, manipulating constructs. What you've covered, in these examples are the volatile constructs. So there are two constructs. One is volatile expiries. The other is quiet expiries. I will cover the volatile expiries first. On volatile expiries, the manipulating entity on expiry day will decide which direction it chooses. It could be any direction. It could be either the downside or the upside. Okay. For the sake of assumption, let's say it's chosen the upside. Now, through the morning hours, from 9:15 to 1 o'clock, the morning hours, it will buy calls in bulk. So it will keep buying at the money call, out of the money call, deep out of the money call. It will buy them extremely aggressively. It buys them so aggressively that implied volatility, which is a measure of how cheap or expensive options are, they shoot through the roof. They become absolutely bizarre and nonsensical in their, in their nature. It is akin to a bottle of water, which typically you would expect to sell for 20 rupees somewhere, selling for 20,000 rupees. It is that odd. It is absolutely bizarre. So, there's someone who's irrationally buying things at a very expensive price. Absolutely bizarre levels. This is because he knows what is going to come in the last half of the day. From 1 o'clock to 3:30, what he's going to create, he knows that. So once he's established his options positions, then having established that, he moves the cash underlying. This typically starts from 1 o'clock, 1:15, he starts moving it all the way up to 3:30. He moves the cash underlying in one steep direction, such that all those calls that he had priorly established which were being bought at unreasonable, nonsensical prices, which had no macroeconomic or fundamental linkage or any other kind of statistical linkage. They made heavy amounts of money. So that was the modus operandi. And the implied volatility also, right? What traders would often do, in case you were a trader, Shailesh ji, you would appreciate that in case a bottle of water was selling for 20,000 rupees
You would
and
try
it was
and sell
trading,
it.
Absolutely.
you would sell it. You would sell it, right? That's the trap.
Yeah.
You would sell it much like a retailer. And then he would basically, take all those calls out and expire it heavily on the upside, such that all those calls that he had bought are in the money. So you see why this is a trap.
Now, Mayank, help us understand. Out of the entire 36,000 odd crore rupees made in profits by Jane Street, about 4,800 crore rupees has been impounded by Sebi. How has this figure come to play, and how has Sebi decided that out of the entire profit, 4,800 crore rupees odd is illegally found? Can this even surge further in the final order? That's the key question.
Yes. So this 4,800 crores has been arrived at from simply the 21 days that Sebi has in-depth investigated. It is manipulation, as I mentioned, has been going on since July 2023. And it stopped only recently. So for 2 years it was going on. 2 years is 500 trading days. 500 trading days. Of those, 21 have been evaluated. That has resulted in a unlawful,
Yes.
gotten gain of 4,800 crores. The patterns which Sebi has described in Bank Nifty are irrefutably there. If you ask any market participant, senior market participant, are irrefutably there in other indices also. So in Nifty, in Sensex, in Midcap, in Fin Nifty, in all these multiple underlying, the same patterns have been there on expiry days. So those gains are also unlawful. Practically of this 36,500 crores, more or less the entirety of it is unlawfully gotten. I would also like to present Jane's profits versus the second best player. Jane's profits of 36,500 crores is for 2 years. I will just compare it for last year. So from Jan to Dec 2024, Jane made around 3 billion USD broadly from Indian options trading. The next largest participant is Citadel on October, another market making hedge funds, who made in the range of 320 million to 360 million.
Okay.
So you just understand the disparity. It is 9x. And Jane Street is not doing what it typically does. Typically, Jane Street is in the business of making markets.
Yes.
It's a market making firm. It does not typically end up taking, very large delta exposures on one side and then moving the index to profit those deltas in the money. That is not what it typically does. So it was very clear from the market dynamics for the seasoned market participants that some heavy mischief was at play. And
Yes.
Jane Street's profit figures tie into it then.
Okay. Let me just, Sakshi, quote from the order. This is page 101, and it says, the Sebi order says that it has been clearly demonstrated in this order that the JS Group again resorted to undertaking prima facie manipulative, extending marking close trading patterns of large and aggressive intervention in the index. Later it says that somewhere in Jan 2025, via the NSE, Sebi had informed Jane Street not to do
Yes.
these things.
Yes,
But-
yes, it is in a show of complete impunity.
Yes.
What's happened is that Jane Street and often these US-based hedge funds, they take India lightly, and that should not be tolerated by India at
Yes.
all. Had
It
the
later-
SEC, had the SEC done this with them, right? Sent a letter.
Yes.
If you continue reading the order, Anant Narayanji, who's written the order, goes on to say that when they had sent the caution letter in January end, I think it was February beginning, when they had sent via NSE the caution letter to Jane Street, they received a very bland response.
Yes.
Imagine
Actually-
this, the market regulator sending and them sending a bland response. They don't have the audacity to do this with an SEC, which is Sebi's counterpart in the US.
Okay.
It's a clear case of India being taken lightly, which is not okay.
Okay, let me just read the part that Mayank has mentioned. It says, the order says, it is in clear disregard / defiance of the explicit advisory issued to them by the NSE in Feb 2025 and it amply demonstrates that unlike the vast majority of foreign portfolio investors and other market participants, JS Group is not a good faith actor that can be or deserves to be trusted. The integrity of the market and the faith of millions of small investors and traders can no longer be held hostage to the machinations of such an untrustworthy actor. So, this is the core of what Sebi has tried to do via this order. Now,
Yes.
Mayank ji, explain to us remedial actions. The reason why I ask you this is from the beginning of COVID, we've had this casino operating at all exchanges, a plethora of weekly expiries that attracts the youth to it, and then obviously you end up making losses. Now, what is, according to you, a remedial measure that Indian markets should adopt? Should they ban FNO?
Not at all. They should not ban FNO at all, because that would be like throwing the baby with the bathwater. It is that. It's like you have a flourishing market in Connaught Place, which has a lot of market activity and sort of economic activity going on, and there are thefts happening. And instead of sort of catching the thieves, you are saying that shut the market down altogether. Don't go to market because there can be theft. So that is definitely a that would be a very, very regressive step. In fact, Sebi, I think only yesterday or today maybe, Sebi officials have suggested that they can decrease the frequency of expiries from weekly to fortnightly. Once again, that would reduce, it's not desirable to not have weekly expiries. Global exchanges in the world have weekly expiries. So
They have daily expiries also.
yes, yes. SPX has SPX 5. I'm aware of that. I just mentioned it conservatively. So SPX 500 has daily expiries, which is the premier index of the US. So I think decreasing the expiries is not the right step. It's like killing the business, and that's a regressive step. Basically, you're essentially admitting that our surveillance is beyond us now.
Right.
We can't catch the thief.
Mayank,
Therefore, shut the market.
latest SEBI study that still mentions 91% of retail investors have lost money in FNO in
Sakshi ji, to your point.
FY25.
Yes. I know.
And
it's
they've mentioned that over 1 lakh crore rupees has been lost in FY25. Individual losses have also surged. Overall, 41% has been surged. Individually, it has gone up to over 1 lakh rupees as well. So what is the strategy that Sebi must adopt at this point in time to protect the small retail investors, and how will a small retail investor ever be able to compete against these massive quant machines?
Firstly, Sakshi ji, understand that retailers are typically at a knowledge disadvantage. Now, that can't be, Sebi can hardly do anything in that.
Okay.
It can introduce the investor suitability test, wherein sort of they have to study for something and upgrade their knowledge before being allowed to participate in the market. And to your point, regarding the massive retail losses which have been there, they have been there in spite of reducing the daily expiries. So if you know,
Acha.
I
So
think
is this linked to Jane Street in any manner, this 91% of people losing money?
It is. Yes, so it is linked to Jane Street, but I'm saying that it's not necessarily linked to reducing expiries. Sebi did reduce expiries in November 2024, but losses have still continued, right? So reducing expiries is not having the desired effect. There are two things that need to be done from the retail point of view. Firstly, retailers also should drain themselves in. That they have to do themselves. Like they should not be trading if they are losing money. Sebi at its end can introduce a investor suitability test, wherein retailers have to pass an exam, which is reasonably tough and which explains different metrics of options trading to the retailers, after passing which they can participate in the market. It's a cumbersome process, but I think it's still required. Yes.
As being in the media for the last 30 years, I can assure you this is now an addiction which has
Yes.
crossed all limits of sensibility. All the shows that we do, people only want to know आज क्या करें, इसको कब तक रखें, और how to make money as quickly as possible. It is a pandemic.
It's a pandemic. It's a scourge, and I think Sebi should introduce some investor suitability test. maybe link the exposures that they take to net worth, because even small people, like very small, like fruit vendors and people who wouldn't have the required resources, they also have started trading options, and they will
Yeah.
naturally lose because they are up against much more knowledge.
Yeah.
It's not They're up against much more knowledgeable people. They've not gone through the knowledge curve, so they are bound to lose. SEBI should maybe an investor suitability test is the answer. Linking the positions taken to net worth. This has been mulled over in the past. Could be another answer. Uh, but a lot of these losses, as the order also covers, you know, is also due to the manipulator. The order
Yes.
also mentions explicitly that perhaps the fact that retailers, as high as 93% retailers are losing money, could also be attributed to the fact that there is indeed a manipulating entity who's creating constructs that trap them. So there should be just elimination, complete elimination of these entities.
Okay.
And
Okay.
regarding the actions, regarding the provisions at SEBI's disposal, uh, this is actually a criminal case. So Section 24 of the SEBI Act allows SEBI to initiate criminal proceedings for serious cases of market manipulation, which
Okay.
SEBI has done in the past against Ketan Parekh, which Department of Justice regularly does in the US, wherein people serve jail terms.
Okay.
Just understand the gravity of the issue here. India's flagship indices, benchmark indices, Nifty, Bank Nifty, Sensex, have been
Yeah.
controlled for 2 years. 2 years. They've been controlled, and they've been sort of, there's a puppet master and puppeteering has been done. They've literally been reduced to that. It's
Okay.
extremely embarrassing for the Indian financial space, and the
Okay.
strictest punishment is due.
Okay.
Uh,
Mayank, two questions. Somewhere in February, SEBI tried to rein in Jane Street and other FPIs by changing the VAR margins and
yes,
preventing
yes,
them from increasing the exposure
yes, it,
unidirectionally. But
yes,
there was a grouping of FPIs that made a representation to SEBI saying
yes,
it's not
yes,
acceptable to us. What is
yes,
your
yes.
reaction to that?
So, Shailendra ji, I have covered via multiple channels that there should be those limits. Those limits were desirable. So I will just tell
Yes.
you the story around this. Those are called gross and net delta exposure limits. And they were brought in with the specific purpose of reining in concentration risks of manipulation. This is something which Anant Rana has himself said publicly in public interviews. And it was very desirable. Now, when the consultation very in a turn of events which was extremely odd, they floated the consultation paper on this, and then they sort of reneged on it. Poor responses from people, and largely it was responded to by an obscure body called the FIA, which represents the interests of the very firms like Jane Street and the other big hedge funds that you would know of. So initially, SEBI had in fact disregarded the FIA representation, saying that they don't agree with it. But ultimately, for whatever reasons, the intraday gross and net delta exposure limits was scrapped. So that was they could have stayed, and basically you either establish the elimination of potentially manipulating entities. Jane
Okay.
Street might be now, there could be others in the future also, either by deterrence, which is the strictest of punishments. I'm talking about criminal charges here. Okay, so you either, and even the fine which SEBI has right now imposed, right?
Yeah.
How can the fine for a crime simply be the proceeds of the crime? Sakshi ji, you would
Yes.
appreciate, in case you travel ticketless, as a benign example, should you be traveling ticketless in a train and you're caught, the penalty cannot be the price of the ticket, right? Then you're
Correct.
incentivizing it's a positive trade because there is a low probability of getting caught. And in case you're caught, it has to be multifold for the justice to be served. Otherwise, so it's a net expected value is positive. So, firstly, the amount has to be much higher.
Okay.
And then this is for a crime which is as severe as this, holding hostage countries' flagship indices for 2 years. Basically, the highest powers of SEBI should be, invoked. I don't see
Yes.
any other issue which could be of greater magnitude than what this is. So if this does not invoke that, then I don't know what will.
Very,
So both should be both, and criminal investigation should be this thing. That is the deterrence wala part, wherein you've created a deterrence via punishment.
Okay.
That is one thing that can be done. If if you're not willing to do that, then the limits have to be very strong, such that it gets flagged at the right. As soon as it is taken, it gets flagged in the system, which is what Shailendra was referring to.
Okay. Mayank, one more question. You referred to the volatile expiry that, you first collect all the options, whether calls or put, depending upon where you want to move the market,
Yes.
and then move the underlying. Now,
Yes.
many of these expiries were flat. You mentioned somewhere in your presentation that the Nifty was managed in a way that all the options that were sold actually expired worthless. How can
Yes,
you
yes.
manage the Nifty not to move? Moving is easy, you buy it or you sell it. How do you manage the Nifty for it to remain in a range of maybe 70, 80 points?
It's not 70, 80 points. It's literally 15 bips. So it would stay in a 40-point range. And
Okay.
that too at the most volatile times. I'm talking about the US-China trade war, which was a big thing in global
Yes.
markets.
Yes.
US was moving, 4-5% every day. At those times, on expiry days, on other days, Nifty would move. But on expiry days, Nifty would stay in a very, very tight range. This continued throughout April 2025. And it was there before, obviously. But I'm just talking about recent examples right now. So throughout April 2025, it continued. Even during the phase of the India-Pakistan war, Nifty stayed in a very, very tight range. So throughout April, it was inundated with quiet expiries. How to not move the market is fairly straightforward. In case the market goes down, you buy it. In case it goes up, you sell it. If you keep doing this, you maintain the market in a very tight range. It's a very simple. If you do it at ample exposure, you will maintain the index in a very tight range. And this
Okay.
is something that he continuously does on the second construct of expiries, which
Sure.
I haven't covered in great detail, which are the quiet expiries.
Fair
Wherein
point.
the quiet expiries, wherein post 11 a.m., he would sell the options in the morning hours. And once he's sold those options post 11 a.m., he would not let the market move from
Yeah.
11 to 3:30. For majority of that is 2/3 of the day practically. So he would not let the market move. The mechanism to do it is fairly straightforward. You can buy the index if it is going down and sell it if it is going up.
Okay. Now, Mayank, you pointed out for 2 years, these flagship indices of Indian stock markets were held hostage in some form. I want to understand from you, would you say that there was any sort of a lapse in the kind of surveillance that Sebi does on the exchanges for such unfair practices? Would you say that at least since July 2023 is what you pointed out when, this entire issue has been starting at, and, you had been consistently talking to the Sebi, highlighting to them all these concerns. Was there also a timely action that was missing in the previous regime under Madhabi Puri-Bhuj under Sebi?
I would not like to comment on whose regime what happened. So that is a comment which I would want to refrain from. But overall for SEBI, which is a going concern institution, it's a clear lapse. It's obviously a lapse. If something is starting from July 2023 and you are releasing the order in July 2025, well, you can't conduct the investigation. You can't be sort of unaware of this for 2 years. And even in the order, in fact, it's been written that they began investigating in April 2024. Now, when they saw that there was a very prominent court case between Jane Street and another hedge fund, which goes by the name of Millennium. So when they saw
Yes.
that court case, then they sprung into action. Now, that is not desirable at all. The regulator cannot spring into action just because a court case has started elsewhere. Its own surveillance should flag it, right? How can it? Should the court case not have happened, we won't have discovered it. Matlab, what is the corollary to that? There is, it can't wake up when a court case is happening outside India. Its own surveillance has to flag it. And NSE has been pretty lax on this. So even the NSE investigation, which started in April 2024, was nudged at by SEBI. Recently, there have been media reports wherein SEBI is clearly saying that what was NSE doing? What is BSE doing? There are also questions being raised as to whether for-profit organizations should be listed in the first place. It is like saying that RBI is getting listed. or Sebi is getting listed. They are NSE and BSE have the responsibility, and multiple times Sebi in both regimes has claimed that they have the responsibility of being the first lines of defense towards market manipulation. After all, it is their trading infrastructure on which all this is happening. So how is it acceptable that they do not know? Is there also an angle that there was, they were maybe tracking this investigation would hamper their profit? Is there that angle? Is also something that needs to be questioned. So NSE has been very, very, very lax, and I couldn't, I can't sort of, criticize it enough for a lack of surveillance. Whatever has been done actually has been done by Sebi, and that too started in December 2024, which is when I wrote the mail to Sebi.
Okay. Mayank, now two learnings. One for retail traders in the FNO space, and one for institutional guys like you. Earlier in the show, we mentioned you are one of the largest FNO traders in the Indian market. How has this impacted your business, your P&L, and your ability to do these kind of trades, maybe?
Okay, so I'll cover the first part of the question first. As far as retail is concerned, I really think they should rein themselves in, firstly. The government, the regulatory body can do things, they can do things, but ultimately they have to do it, like they have to rein themselves in. Like if someone is continuously smoking, then there can be warnings and all of that, but they have to put themselves in check. So that is the first thing. Regarding the second thing, senior people recognize these patterns. So one can always follow these patterns, without, you can participate with the sort of manipulator. So it does not hurt the businesses of the large institutional people because they're experienced enough to recognize these patterns. So, personally and for businesses, it's not got hurt because people can follow manipulation. Like they can see the trends in implied volatility, which is a measure of how cheap or expensive the option is, and get to know from there what the manipulator is planning at the end of the day, and then align yourself in that direction.
Okay. Mayank, one question which is, let me just play the devil's advocate. If Jane Street were doing all these activities in 4 unrelated entities, for the moment, Sebi has a bird's eye view on the entire work process of Jane Street, the 4 PAN cards that have been mentioned. If 3 or 4 institutions which are not related to each other, but at the back end decide to do this, which is 1 month I will buy cash and you buy futures and the third person buys options. In the other month, we will reverse this in a manner that 1 month I make profit, 1 month you make profit, 1 month Sakshi makes profit. No law is broken. Do you think that's possible?
No, law is still broken, Shailesh. Obviously, it's it requires a higher degree of surveillance, but law is still broken. What Sebi has to do is that it can't pick. In the current case, this is not the case which you're saying, but in general, if this were to be the case, wherein multiple PAN cards were involved, multiple entities were involved, then you have to see the subset of all entities and see which entities are repeatedly acting in conjunction. If you find over a long enough period that, every time this pattern happens, these entities come together to sort of create these kind of trades, then there is a clear case of collusion, and then you have to ban all those entities. So it will still remain illegal. It's just collusion. It's just manipulation via collusion. Okay. Surveillance required will be slightly higher. We'll have to do a slightly deeper dive into surveillance, but it will still remain collusive. Here too, if you notice Sebi's order, the Indian entities were set up solely to take intraday cash trades. Intraday cash trading is not allowed for FPI entities. Okay, so they couldn't do intraday trading, buy sell of stocks at buy in bulk and then sell in bulk. So very craftily, Indian entities were created which are allowed to buy sell intraday, in the cash segment. The profits have also been qualified as business income by the Singapore entity.
Yes.
Which means that of the profits of 44,000 crores that have been accrued in options, not a single penny of tax has been paid to the government of India.
Correct.
So just understand the entire, it's a plan. It's orchestrated. It's pretty evident.
Do you think now the probe should be extended to even high frequency trades, other quant strategies that may be at work? What do you think the next step should be? Sebi has already highlighted that they are going to be increasing their surveillances even beyond Nifty and Nifty Bank to other indices as well. What else should the Sebi be really looking at to really act as a deterrent to any next Jane Street?
So
Issue?
firstly, as a bare minimum, the penalty, as I mentioned, for what has already panned out now, should be multiple times the proceeds. It can't be they've discovered 4,800 crores of unlawful gains and impounded 4,800 crores. This does not work. This is it should be multiple times that. Ultimately, I think the entirety of 36,500 crores or thereabouts are likely to be found to be unlawfully gotten. So the penalty has to be to the tune of 1 lakh crores, and it has to be multiple times that basically. Jane Street should definitely be banned and definitely criminal prosecution. Had this happened in US, there is no way, this would not have attracted criminal prosecution. Even within India, Ketan Parekh, as I mentioned priorly, has faced jail term for precisely this kind of market manipulation. And Sebi's Act mandates Sebi practically to, in cases of high-level market manipulation, which there's nothing more high-level than this, they have the provisions to initiate criminal action. Once you have a high enough deterrence, then people do not go about committing that crime. As a prima facie, if you have a large enough punishment. For example, there is, take for example, murder. People don't go around murdering people even if they have a knife, simply because obviously it is immoral and people have a moral compass. But another thing which comes into play is that the deterrent is very high. The punishment is very high. So if the punishment is high enough, then people are deterred from taking a criminal activity. That is step number one. Step number two is that you should have limits such that whenever someone takes outsized exposures, that gets immediately flagged in the system. And the limits which Shailendra mentioned, which Sebi had proposed in February, the gross and net delta exposure limits, those are in that direction. So yeah, you have to prevent, future recurrence. In fact, Sakshi ji, to your question, I would like to point out that only about a week back, there were 2-3 days wherein a new manipulator had entered. A second, I could say it was a new manipulator because the patterns were different from the patterns that were there when the original manipulator, which presumably is Jane Street now, was manipulating. So a new manipulator tried to enter. And that manipulation has gone post the Sebi order. Like, he didn't come yesterday, for instance. So you have to create a deterrent. It will work. And you need to have surveillance limits also, obviously.
Let's hope that the actual name of the new manipulator is not Tarzan. Otherwise, it will be me, Jane, you, Tarzan. Let's hope it doesn't work that way. And in one of the paragraphs of the 105-page order, Sebi does mention that the bank balances of Jane Street are so low that this 36,000 crores has already been repatriated. So
see, if you're acting so late, you're taking 2 years to act, then all these issues will obviously, if someone is trying to make money unlawfully, he will obviously repatriate naturally, right? So you can't wait for 2 years to release this order really. Your surveillance has to flag this in the first week or 1.5 weeks of this happening. It can't be that a US court case has come and then you begun the investigation, then you gave it to NSE, NSE was lax, then NSE gave it a clean chit, then you began investigating when someone presented to you, then you finally released it in July 2025. The surveillance has to be better, which in fact Tuhinji has also recently spoken of.
Okay. One of the paragraphs mentions that during the same period, JS Group FPIs were holding an average of 15,325 crores worth of Indian government securities, which I presume they were using as a pledge to raise margin.
Yes, naturally. And even now the order has, I think the order has restrained the movement of those 15,000 crores. But it goes on to say that 4,000. If you give 4,800 crores, then you can commence trading again, which it shouldn't say. Matlab, I am no one to say this, but after such a crime, the entity should be permanently banned and criminal proceedings should be initiated.
Sure.
It's not you can start trading.
So you think this 15,325 crores of government securities are still in India?
I think so. As far as I recall reading the order, I felt that. But that is, you see, Shailendra, you're assuming that the proceeds of the crime are simply 4,800 crores.
Yes.
It is likely the entirety of mostly that.
Got it.
Plus, Sebi has still not investigated Bombay Stock Exchange. So 36,500 crores is from NSE alone. There were manipulated expiries, severely manipulated expiries on the Sensex expiry also, which has not been touched. So you can add maybe 6,000-7,000 crores further to this figure, which takes it to 43,000 crores.
Maybe we just would have opened a can of worms and there has to be a much detailed, in-depth coverage by Sebi. How would you respond to what Jane Street has called on the Sebi order? They call it a fundamentally mistaken order as well. I will just read out some of the statements. This is Jane Street's internal letter to their employees, which media reports have accessed and come out with. They have said that Indian market, the allegations of market manipulation is fundamentally mistaken in the internal letter to the employees that Jane Street has sent. The firm defended their trading activity as basic index arbitrage. They have rejected Sebi's charges of the strategy as manipulative. They have also said that they are preparing a formal response for sure and exploring legal options. But they have also mentioned that consistently in the letter to the staff over the weekend that they have accused Sebi of using inflammatory language and displayed a misunderstanding of standard hedging practices and the interrelationships between derivative and underlying markets. How would you respond to that?
This is absolutely nonsensical. The response is pretty much that. I will tell you what they mentioned in the letter. Okay, if you see the order, okay, firstly I will come to the point of index arbitrage. That is their key key point. Other things are just like English. They are just English. Their key point is that they were doing index arbitrage. The rest, inflammatory language, is all soft things. Nothing can be said or against or for those things. I'll come to the key point, which they are saying is index arbitrage. When you do cash future arbitrage, right, you take the same exposure in cash that you take in futures. It is 1:1. Shailendra, I believe you've been a market participant for some time. Yes. Cash future arbitrage involves buying X amount of cash and selling X amount of future to lock in the risk-free rate, the arbitrage rate, 6% per annum, something to that tune. That is what arbitrage entails. In this case, the sizes were 1:8. You can't be buying cash in X and then selling 7 to 8X in forwards. Forwards are sort of futures of the same day expiry. So, like we have monthly futures.
What they were trying to do is make tons of money on the options trade and make small losses on the cash or the futures of that same index or same stock. So if you are moving the Bank Nifty, you make lot of money on Bank Nifty options and you make some losses on HDFC Bank equity, which you may have bought to raise the Bank Nifty option price, and maybe some stock futures of ICICI Bank. So net में Sebi says they lost 7,000 crore rupees on index futures, stock options and cash equity, and they made 36,000 on option. 43,000 on options, and this is only 21 expiries, ladies and gentlemen. Only 21. So this is an interim order. This will get thicker and thicker, and Mayank ji will be at it till everybody who's manipulated 2 major indices or 3 major indices gets punished. Absolutely.
I have one point to, I would just like to sort of add to what Sakshi ji asked, regarding the index arbitrage. I just want to close it emphatically so that it is clear for the viewers. It will just take a couple of minutes. So in index arbitrage, you sell the same amount of futures or forwards as you've gone long in the cash. What was seen here is that when they were buying cash, they sold 7 to 8x in futures. This is no form of index arbitrage. You can't be going long X and then selling 7-8X. Also, what will be continuously observed is that when you do index arbitrage, right, you're waiting for the spread to compress, right? It's you wait for it to compress. So when it compresses, roughly 50% of the time, the cash segment is expected to make money because they're converging. 50% of the time, the cash segment will make money. What you will observe in these instances is that always options will make money and cash will lose money because cash and futures are being used to move the index. So
Yes.
there's a difference. It can't be index arbitrage. Index arbitrage is not 1:8, and one leg cannot continuously be in losses because converging will mean that roughly 50% of the time, one leg, the cash leg will also be in profit, but that is not the case.
Sakshi, it's very simple. Suppose Bank Nifty is at 55,000
Yeah.
and at 50,000 and you are buying calls at 50,800, 50,900 and then you use HDFC Bank to move the index all the way up to 50,800 or 50,900. You make so much of money on the calls because they become in the money.
In the money. That's what. Yeah.
And that's exactly what they did. Mayank ji, we could have gone on and you could have gone on, but time is of the essence. And thank you so much. What
Thank
a
you.
pleasure listening to the inner workings of how institutional investors such as you trade. And thank you for highlighting this for the benefit of Indian markets, for its continued strength and of course for it not to be manipulated by foreigners. Thank you for your time.
Thank you, Shailesh ji. Thank you, Sakshi ji. The pleasure has been all mine. And thank you very much for calling me.
Thank you.
That, ladies and gentlemen, was Mr. Mayank Bansal, the president of a UAE-based hedge fund, who in his individual capacity nailed Jane Street. His research, his highlighting of the antics that Jane did on Dalal Street in manipulating options and its underlying index as well as futures and component stocks has resulted in this order, which for the moment is 4,843 crores worth. But the size of this order and the fines that will be collected will increase in magnitude. Thank you for watching, and I hope for those who want to enter FNO even now will at least exhibit some caution.
At this point in time, for sure. With that, viewers, we'll wrap it up on this very special conversation and the edition. I hope this has given you so much more understanding as to how Jane Street really manipulated, what are the things that are happening, and how you as a retail trader must be very, very cautious when you're trading with your own money, more so with leveraged money at that point. Many thanks, Shell, and viewers, we'll get you the market coverage right after, so stay tuned.
जब ये CAQM के द्वारा